Well, the Fed meeting outcome and the expectation around it is all around just one word: taper talks. Will the FOMC taper the $120 billion government bond buying program, which has led to a lot of cheap money, as we call it, flooding the market? Well, perhaps even if not a complete taper or an announcement of a taper, Jerome Powell may take some baby steps towards tapering. In terms of other expectations, we are expecting the interest rates to, largely just stay where they are at 0 to 0.25%, because most don't expect the first interest rate hike to come in before 2023. And that's another part of the Fed expectation, that the dot plot will continue to show that, the first rate hike by the Fed will only come in the beginning of 2023. Inflation, this is the other big parameter factor that a lot of individuals are watching out for, because the previous reading showed that US inflation hit 5%. We have never seen a 5% figure, coming in inflation by the United States or in the United States in the last 13 years. Now, back in March, the Fed had a very modest inflation expectation of around 2.2% for 2021. So in all likelihood, Jerome Powell and team will be revising this inflation expectations upward. Now, the context really of this meeting, this June FOMC meeting, comes, like I mentioned, first up, the headline inflation is at a 13-year high. Core inflation, in fact, is at a near 30-year high. The yields are hovering near a 3-month low. The reverse repo volumes have actually soared to record high levels. And the dollar index, which, by the way, has been completely thrashed out of shape, has managed to just about recover to about that 90 level. So apart from, the inflation bit, there has also been quite a few improvements on the macro front as well. For example, the GDP reading, the latest annualized GDP reading was roughly more than 6% compared to, the Q4 reading just before the April meeting, which was at, about, a little over 4.5%. So there has been a drastic improvement in the GDP reading. Even the US jobless claims, the 4-week average, has dropped quite significantly from more than 700,000 in the reading just prior to the FOMC April meeting to now where it is around 402,000. So there's been a fall over there as well. So overall, the macroeconomic environment does seem to be improving quite a bit. Inflation, of course, is the only problematic, macroeconomic parameter for the Fed, and there we could expect an increase in the in the inflation projection. But there are two ammunitions in Jerome Powell's kitty that he can use. Firstly, a rate hike, but we're not expecting the first rate hike to come in until 2023. Secondly, steps to look at slowly tapering down the QE program, the $120 billion government bond buying program. This step could boost the US dollar. It could, however, lead to a sell-off in the bond markets and in the stock markets as well.